All right, my heroes, we're back. Really exciting stuff. Now we're really getting to the nitty gritty. The last couple videos and lessons we've been talking about this concept of options being priced off of two things. They're priced off one, they're distanced away from the current price of the stock or the ETF or whatever the options are for. Right? And that's always static in the sense that if we have a stock that's at $250 a share and we have a $251 call, that's going to always be $1 away as long as the stock is at 250, right? However, the difference maker is the second thing that options are priced off of, and that's the actual expected move. And then we kind of went into this like big thing that, hey, options get their initial price and they trade off of the expected move, right? The expected move is what they trade off of. And then they are finalized and settle based off of the actual move. And then we went into a little bit more and actually showed you visually charts where compared over time, the expected move is greater value than the actual move. And if those are both are true, which they are, then that would mean that options are overpriced. So if options are overpriced, there's got to be a way to profit from it, right? If options are overpriced, there's a clear edge in there, right? There's a clear edge in there. So I want to kind of get into it. So again, if options are overpriced, there's got to be a way for us to actually make money from it. And remember, looking at this chart right here, we see in black is the expected move, right? The S&P 500 implied volatility, remember, is the VIX, which is just the expected move over the course of a year. So the black line here is the expected move. Another way to think of it is the black line here is how options are priced. The orange line here, which about 80% of the time is less than the black line, is the actual move. Again, the actual move is how options prices are finalized and settled. So clearly, for the majority of the time, 80% of the time, options, because they're priced off the expected move and then get finalized and settled based off the actual move, are overpriced. So there's got to be some way to profit from this, right? There's a lot of naysayers out there that are saying, well, Steven, like I know this is true, but it's a zero-sum game. It's a zero-sum game. Like there's no way that you can actually make money from this because if there was an issue there, then there's no way it would be like that, all that stuff. So I completely get that. So what we want to do is we want to see if there is a way for us to profit and place a trade that is no more. So we're not getting into the complicated stuff about what these strategies really are, or these trades really are, but we really just want to be able to place a bet on a trade that is no more than a bet that the expected move will be larger than the actual move, right? Now, go back to a couple of videos before. We were talking about delta, and we were talking about an actual normal distribution curve, right? So I'm going to bring this back into the forefront here because it's very, very important. So again, this chart down here is just a normal distribution curve, and what the normal distribution curve says again is in a random setting with enough occurrences, price movements or these random occurrences will fall within the expectation or the expected move, which is the equivalent of one standard deviation or one sigma, 68.2% of the time, right? And then I guess it was like 95.4% of the time they would fall within two standard deviations and so on, or whatever it is, right? But again, because you cannot predict forward earnings and because there is no positive drift to the market anymore because the risk-free rate of return is zero, that means that buying a stock outright is only 50-50. If it's only 50-50, that means all price movements are very much random at the end of the day. So that's why we can go ahead and take what we see here in just a normal distribution curve and be able to extrapolate it out to options, right? So options, we have the 16 delta put and the 16 delta call. Why do we have the 16 delta put and the 16 delta call? Well, if you take 100, you subtract 16 from one side, you have 84%. If you subtract 16 from the next side, you have 68%. So again, that's what, and then in between those, right, when we sell a 16 delta call and we sell a 16 delta put, we're betting on prices falling within that. That is the expected move. So let's go over to our platform here real quick and let's show you how to do that. So if we're going to go to SPY and we're going to find the 16 delta put. That's the 21.31 strike. So if we sell that, we are hoping to make money. If now remember, everything is building off of the previous lessons. So if we sell this put, that's a 16 delta put. This gives us an 84% chance of being profitable just on this specific trade, and we are profitable if SPY finishes above 231 34 days from now. Or another way to think of that is the 231 strike. The 231 put is out of the money come expiration. So that's on the one side, right? So that's on the put side over here. That's like selling the 230. That's like selling the 231 put. Now on the call side, we want to find the option that's closest to 16 deltas. Again, why do we want to tell that 16 deltas? Well, from here all the way over is 84%. We want to sell the option that gives us an 84% chance of making money. That would be the closest one to the 16 delta call. So we have it over here. We're going to sell the 250 call, right? So what we're hoping for here is two things. We're hoping that the price of SPY finishes below 250 on expiration 34 days from now, and that the 250 call is also out of the money come expiration. So when we sell the 250 call and the 231 put, this is the expected move in SPY over the next 34 days, right? This is that normal distribution curve. This is that dark blue line in the middle here. What we just did, selling the 16 delta call and the 16 delta put. Because again, if you take 100%, you subtract 16, you get 84%. So if you only sold the 16 delta call, you'd have an 84% chance of making money. But then if we sell the 16 delta put at the same time, you have to take away 16% chance there. That gives you 68%. So there's a 68% chance, again, just like the normal distribution curve says, in the law of random occurrences says 68% of the time prices will fall within their expectation or one standard deviation. So this is what we're doing here. Now, without getting like too crazy, because we have plenty of lessons later on in the course about this. This trade is just called a strangle, and I'll show you how they actually do it on the Thinkorswim platform. So if I click on the bid here and then I go down to the actual 231 put, I hold down Control and I click it. This is actually a strangle. So don't get hung up on what it is and all that jazz and how to do it right now. There's plenty of lessons in the future that will explain the right times to do it and how you do it and all that stuff. But for right now, we're very, very focused on just being able to prove that options are overpriced. Again, we're just placing a bet here that the expected move will be larger than the actual move. So in this case, if the expected move is larger than the actual move, we will make money. If the actual move is greater than the expected move, we're going to lose money, plain and simple. And again, we've seen all these other charts here where 80% of the time, for the most part, 70-80%, the actual move is smaller than the expected move. So that's just what we're looking to prove here on this trade. It's nothing crazy. We're just saying, hey, if prices are random, we expect, we expect that the 16 delta call and the 16 delta put is the expected move. However, again, we believe that options are overpriced. If they're overpriced, we should expect to do a little bit better than 68.2%. If they're not overpriced and they're priced perfectly, we would expect to be right 68.2% of the time and make no money. Remember, conventional wisdom on Wall Street says, hey, it's a zero-sum game. One side makes money, the other side loses money, and that's it. There's no in between. My argument is it's not a zero-sum game, and we're going to actually start to show you that now. So again, if options are overpriced, we want to place a trade that is a bet that the expected move will be larger than the actual move. By selling a 16 delta put and a 16 delta call, we're pretty much saying, hey, we want to place a trade where both the call and the put are out of the money at expiration. That means the stock price finishes in between them, right? So if this is true, that the expected move is greater than the actual move, this is actually a profitable trade, right? Because again, expectations are what the options are priced off of, and then the actual move is what the options settle to. So what we did was we did a study, right? And this is a big study, guys. This took me like weeks to do, but it's very, very important that I did it. Even though it's only like 2 slides, it's critically important that I did this. So from 1990 to present, that's over 6,500 occurrences. So those are enough occurrences so that we have a really accurate representation of, again, all we're trying to do is see if we can profit from the expected move being greater than the actual move. And we did it in SPY for a few reasons. Number one, you guys already saw the lesson on liquidity. SPY is the most liquid product in the world, which means that the probabilities that we get out of SPY are typically the most accurate across the board. The second reason I did this, so I have not been trading since 1990. However, the public data for SPY is available till back then, and it's very difficult to get that type of data for other stocks or indexes. So that's why we did an SPY. So what we did was every single day, we sold the 16 delta call and we sold the 16 delta put, right? And we did it in the monthly expiration cycle closest to 50 days from when we placed a trade. And again, that's called a strangle. Don't worry about that too much. Don't worry about that too much right now. Just we think about the way you can think about it is we place the expected move trade every single day in the closest expiration cycle 50 days. And then we just held them to expiration. Because again, when we hold them to expiration, we can prove in that 50 days, was the actual move greater than or less than the expected move? Which again will prove to us that, hey, in that 50 days, were those options overpriced or not, right? So there's nothing crazy. Now again, conventional wisdom is going to say we should be right 68.2% of the time. And we should not make any money for the most part, right? Because again, it's a zero-sum game. You know, if it happens, if you're supposed to be right 68.2% of the time or just 68% of the time, you're going to be wrong 32% of the time, right? So, and those will wash out because your losses will be greater than your winners and you will make $0. So again, that is what conventional wisdom is, and it's very, very important to understand that. That's what most people would say. However, we've shown you that we believe that based off of just a chart like this, which is pretty simple, the expected move, which is implied volatility, has been greater consistently than the actual move. And if that's true, we're going to, again, try to place this trade that shows if we sell a strangle, which again is just a bet, a 16 delta call and a 16 delta put, it's just a bet on the expected move, that we should make money. So here are the results, and this is really, really important that you guys understand this. So again, 6,500 occurrences. We did this every single day. I believe that 6,500 plus occurrences is a large enough sample size for these numbers to be legit, not baked in, not curve fitted or anything like that. So on the left side, we see the expected outcome. So the expected outcome, again, if we're selling a 16 delta call and a 16 delta put, and a normal distribution curve says 68.2% of all random occurrences will fall within the expectation or one standard deviation, right? So that was the expected outcome of the trade. However, we believe that options are overstated are overpriced because the expected move is typically greater than the actual move. Options are priced, they get their initial price off of the expected move, and then they settle and are finalized based off the actual move. So we expected to only be profitable 68.2% of the time, or conventional wisdom says you were only going to be right 68.2% of the time for $0 a trade. Remember, it's supposed to be quote-unquote a zero-sum game. One side makes money, the other side loses money. However, doing this every day, we were right 81% of the time for about $41 profit on every single trade. That's some serious stuff, guys. That's some serious, serious stuff. Look at this. We believe that options are overpriced. And the reason we believe that they are overpriced is because they are priced off of their expected move. Then they settle to their actual move. And over this chart is about 10 years, it's pretty clear here that this black line, which is the expected move, is typically greater than this orange line, which is the actual move, right? And again, we're just placing a trade. We're selling a 16 delta put. We're selling a 16 delta call. This is just pure math. I'm not making any of this stuff up. It's called a strangle. That is just a bet on the expected move. It's a bet that prices will fall within the expected move, right? We did this study every single day for 27 plus years, and the results are pretty telling, guys. They're pretty telling. We were not right 68.2% of the time. In fact, we were right 81% of the time. we didn't make $0 per trade, which is what it's supposed to come out with as far as conventional wisdom is concerned. We made almost $41 a trade. So this is where the edge is, guys. This is where it is. Not only have we shown, that options, that the expected move is greater than the actual move. Not only do we know that options get their initial price from the expected move and then are finalized and settled to their actual move. And not only do we know that, but then we place the bet. We place the bet that would prove that the expected move is greater than the actual move, because again, we only make money if the expected move is greater than the actual move. And it looks like 81% of the time we were profitable on this trade because, like I said, and I have been saying for the last couple of videos, about 80% of the time, give or take, the expected move is greater than the actual move. So this is kind of the start of the new beginning for you guys. This is very, very exciting stuff. This is a big deal. We're going to take this to levels that you didn't even know existed. This is just the tip of the iceberg. Don't worry about this trade too much. There's a ton about this later on in Market Hero. There's a ton about this, and there's going to be a bazillion studies about this, so don't worry too much about this. The thing to know here is that we placed a trade that, again, is a bet that the expected move will be larger than the actual move. And we won that bet 81% of the time, when conventional wisdom would say you should only win that bet 68.2% of the time. So this is really, really good. We're going to expand on this, and we're going to turn this into much better than 81% in the next few videos. So I will see you there.